Hello viewers, this is Dr. Alok Chajed on Already Late, a channel that brings to you insights into the world of personal finance, investments and economy in the simplest manner. International rating agency Moody's has downgraded India's sovereign rating to Baa3 from Baa2 and also has maintained a negative outlook on the ratings. Let us understand what this means and what are its implications to our economy and to our markets. First, let us understand what does this Baa3 mean. Every rating agency has a nomenclature that it uses. Moody's has a range starting from AAA, which is indicative of highest quality and lowest risk of default. This is followed by AA1, AA2, AA3, A1, A2, A3, Baa1, Baa2, Baa3, and it goes on to CAA1, CAA2, CAA3 and C, which is the lowest credit quality and the highest risk of default and absolutely low probability of recovery of interest as well as principal. India's current rating Baa3 indicates medium quality, some speculative elements and moderate credit risk. If you observe the rating scale carefully, you see that I have divided the scale into two colors. The green line reflects investment grade and the red one reflects speculative grade. A closer look at the scale and you will clearly see that the current rating is the lowest in investment grade. And if we get downgraded further, we are entering a zone of speculative grade, which will be extremely bad for our economy. So the question is, what caused this downgrade? According to Moody's, Indian government and other policy making institutions like the RBI will face a tough time in implementing policies to overcome the slowing economic growth, which will further deteriorate the government's finances and add to the stress in the already ailing financial sector. So was this downgrade due to lockdown or due to COVID-19? Now yes, COVID has been a trigger for this downgrade, but you cannot blame COVID for this completely. Our economic situation definitely went for a tailspin due to the lockdown. But as I have been saying earlier too, our economy was in trouble way before Corona hit us. Even Moody's has opined the same. Moody's has stated that COVID-19 has only amplified India's vulnerabilities, which were already present in our system. Indian economy has not been growing to its potential. Our real GDP has declined from a high of 8.3% in financial year 16-17 to 4.2% in financial year 18-19. Moody's expects India's real GDP to contract, mind you, contract by 4% in the coming financial year. Yes, Corona, lockdown, everything has happened. And followed by 8.7% growth in the coming year, fiscal 2021, and thereafter around 6%. Over the longer term, growth rates are likely to be materially lower than in the past due to the weak private sector investment, limited job creation, and an impaired financial system. Now, we might be wondering, the government has taken a lot of measures to stimulate the economy. Will that not help? Now, if you have watched my analysis of the stimulus package, I had opined that unless measures are taken to boost demand, nothing much would happen. Now, Moody's also share my view. Moody's is not expecting that these measures, the measures taken by RBI and Finance Ministry, will restore real GDP growth to the rates of around 8%, which looked very, very reachable just a few years ago. Further, with a prolonged slowdown, Indian banking industry will see more stress, higher NPAs, and the banking sector is likely to weaken further. Moody's has also factored in other reform measures announced in agriculture, mining, defense, and power. They have taken into account the measures for ease of doing business. The report says that while achieving the objectives laid out in these announcements would be a big positive, challenges with implementation of previous reforms, such as that the benefits to medium-term growth is likely to be less than what the government intends to. The slowing economic growth will cause another headache for the government. It will lower its ability to reduce the big debt that it has. Over the past few years, government has been trying to bring down fiscal deficit but now it will be difficult for them to continue, and the focus will not be on tightening of the fiscal deficit. Now, as if the rating downgrade wasn't enough, Moody's has also maintained a negative outlook on the ratings. Now, this is because the downside risk from the stress in the economy and financial system could lead to a more severe and prolonged erosion in fiscal strength. Now, that's a big worry. Can ratings be upgraded? Yes, certainly they can be upgraded, but it is highly unlikely that this happens in the near future. Let me just give you a historical perspective. This downgrade comes after an upgrade in our ratings in November 2017. I'm talking about Moody's rankings. This was based on the expectation that effective implementation of key reforms would strengthen our creditworthiness through improvement in economic, institutional, and fiscal strength. But the agency, Moody's, is of the view now that implementation of these reforms has been very weak and has not resulted in significant improvements, which means limited effectiveness of all the measures which have been taken. So unless things change dramatically, any upgrade in the near future seems unlikely. So what is more likely to happen is the change in outlook from negative to stable. Now, this can happen if government actions were to raise a confidence that the real and nominal growth will rise to sustainably higher rates than what Moody's project. Let it reduce government debt and let it strengthen the financial sector. Probably will change our outlook. So what's the likely impact on markets? As I have mentioned multiple times earlier too, markets move on expectation. This downgrade, fortunately, is not totally unexpected for two broad reasons. One, the economic stress has been pretty evident, especially after Corona broke out last 2 months. The economic stress has been very, very evident, very, very visible, so nothing unexpected. Further, two other prominent rating agencies, Standard & Poor and Fitch, they already have ratings for India assigned, which is equivalent to what Moody's has downgraded us to. So now what happens is three leading agencies are on the same page as far as India's ratings are concerned. So all in all, the impact on the markets should not be very significant. The impact on currency could be weakening of the rupee to some extent. Bond yields would rise, again, probably in all probabilities to some extent. And stock markets, which have been an upward move for the last 3-4 days, may take a pause or use this as a reason to find some lower levels. All in all, this news alone does not seem to be enough to pull the stock markets down to a new low or to near current lows. There might be more than just this news. To summarize in one line, Moody's rating does not come as a surprise, but the negative outlook can be a mood spoiler in times to come. Do like the video and share it with your contacts, and do not forget to subscribe to my channel if you have not done it yet. Happy learning. Thank you.